yields have come down on prime, but then the cost of money has come down. So I think it's better a question for the investors to answer. But I think the relative, as the second chart suggested, the relative benefits of investing in prime real estate are still pretty good. In relation to secondary, what makes secondary? It's a pretty wide question. One of the things that did happen in the last downturn is that you had a lot of shopping centres that didn't get any new investment. Let's paint a picture of a 150,000 pop town with 3 shopping centres around it. One of those shopping centres was owned by Unibail-Rodamco, who could raise money at 2%. And guess what? They kept investing in the shopping centre and getting the latest retailers. And guess what? That shopping centre is now the lead one in that market. There was another shopping centre that was owned by an institution, and they had some access to capital, but maybe not quite the same specialisation as Unibail-Rodamco. And then you had a third shopping centre that was owned by a fund, which had gone through its investment period, didn't have any more access to equity, and the banks wouldn't lend them any more money. And guess what? Now that shopping centre is looking pretty tired and is definitely secondary. Now that shopping centre may not have any fundamental location issues, but it's just been underinvested and is less attractive to the consumer. And that's a good buy for an opportunity fund. That's a good buy for Blackstone and Multi to pick it up and turn it around. So yes, there's good opportunities in secondary sometimes, but I think there's still possibly good value in prime as well. So I think both those things exist.
Yeah, we've got to make one sort of statement. Not every shopping centre is managed to the same standard as each other. That there is a variance out there. There's also different factors in the market. As John said, there are funds that have run their course. There are people that took out too much debt in the last cycle, and they're the people that are going to sell core if they're, and there may be core that isn't as well managed as it should be. So there is a variance in the market. It's having the knowledge to be able to see the variance that you can turn around and that you can't. And if you get that right, and we hope we generally get it right, then there's a real opportunity out there at the moment. But there's always the risk that you don't get it right. And we've seen examples of both. And that goes for every single market. You look at Spain now. We were talking about the capital that's flooded into Spain. We're still buyers, but we're also sellers in Spain. It depends on the product that we're dealing with. So you can look at almost any market in different ways depending on the asset you're looking at.